Welcome to PhillipCapital's Weekly Market Watch. Despite past numbers showing that September is generally a weak month for the stock markets, this has not proved true this year. With us today is Ms. Hilary Ho, investment analyst from Phillip Securities. So Hilary, as we draw towards the close for the month, could you give us a brief summary of how major markets have performed?
Okay, as mentioned previously, September has traditionally been a weak month for equities, and we thought this year would not be an exception. Besides, given the massive run-up since March, a correction was actually much expected. Okay, however, after some lackluster market actions in the beginning of the month, stronger economic and corporate news lifted the major indexes once again. Okay, as of last Wednesday, Dow has gained approximately 2.6% for the month, while S&P 500 rose 3.5%. So in Asian markets, Shanghai Composite Index gained 6.5%, while our local bourses rose as much as 3.5% as well.
How did this happen?
Okay, I think we probably underestimated the reversion of risk appetites. During the crisis, we saw investors and business sharply pull back on the reins and curtailed their risk-taking moves to an unprecedented degree. So given that economic conditions have improved, appetite for risk returned. This is evident from how frontier markets continue to emerge as some of the best performing markets for the past couple of months. Vietnam's Ho Chi Minh Stock Index, for example, has been one of the top 10 performing equities market for the last few months.
You have been skeptical about the rally despite improvements in economic data. Could you elaborate on the reasons?
Okay, for several months, we've been building on a case of pessimism, a case that recovery will be slow as consumption, the main driver of the economy, remains lackluster. So with unemployment rates still high and wages still on the decline, it reinforces the point that spending will remain controlled.
Moving forward, do you think there's probably a case for optimism?
Okay, we have previously mentioned that consumption could be spurred with the bottoming of housing prices. A bottoming of housing prices is necessary to increase individual household assets values and thus encourage consumption. The quarterly Case-Shiller National Index suggests that housing prices has increased by a seasonally adjusted 1.4% in the second quarter. The monthly S&P Case-Shiller Composite 20 Home Price Index also increased 1.4% in June. Okay, this is the second month of actual gains. The alternative FHFA Purchase-Only Housing Price Index showed that housing prices is on the rise as well, and it has rose for 3 consecutive months. Okay, it gained 0.3% in July. This indicator suggests that housing sector is in fact bottoming. Okay, and in turn that will actually encourage consumption. In addition to that, it was also recently announced that US household net worth expanded by $2 trillion in the second quarter. Okay, these gains came as a result of rising equity prices. So once again, with the rising wealth, consumption can actually increase. As such, there's probably a case for optimism.
Is it going to be all smooth sailing?
Okay, there are increasing signs that economic recovery is gaining pace and is on its way to establishing a self-sustaining path. However, we should bear in mind that the recovery came about because of relentless support from the government. Okay, therefore the prime concern now is whether the Fed is able to engineer a successful exit strategy and still maintain economic momentum. Undoubtedly, the process of reversing the unconventional measures is an extremely delicate one, and risk of going too fast or too slow can have tremendous effects on the economy.
Thank you, Hilary. That's all we have for you today. Tune in next week for more market updates.